All right, step four, the path to consistently profitable. So we looked into back testing. By now, you will have back tested some of the strategies that you made note of, and you probably will have found some strategies that you're going to strike from the list. You're going to move on and narrow down a bit more. Um, we're calling step four forward testing, but as noted, if you're a position trader or an investor, you probably are going to live mostly in back testing. However, the information that we're talking about here applies equally if you're back testing for position trading or if you're going to start forward testing for swing trading and day trading. Let's go back to the Palantir chart and continue our example from where we left off. So you will have gone through this. You have recorded all of these events, or at least we did for the example. Now what we're going to do is we're going to look into adding an indicator. And what you'll do is you'll go through several indicators, probably start with the most popular ones. RSI is usually the top of the list. So we're going to go ahead and take a look at RSI here. We're going to add this in as an indicator. Let's look at our first event here. We can see that shortly before our first breakout event, RSI, the fast line, we have technical names for it, the fast line crossed the slow line. Just a quick explanation on what RSI actually is. So the fast line takes the last 14 candles and basically if it was a gain on the day or a loss on the day, it adds or subtracts that up 14 times, the last 14 candles, and creates somewhat of an average. Then it turns it into more or less a percentage because RSI goes from 0 to 100, even though they don't call it a percentage. That's basically what it is. So that's the fast line. The slow line is a moving average of the fast line. So that's why it's a lot slower. Going back to the example here, uh, we can see that just before our breakout, we had the fast line on RSI cross the slow line. So what we could do is we could use that as an additional criteria, and we could create an extra column in our spreadsheet if we're forward testing. You create a new column and you call it RSI crossover, whether it's just a binary, yes, it crossed over, no, it didn't cross over, or whether you're actually recording numbers is up to you. And as you get better at this, you'll see whether it makes sense for you to record the actual numbers that RSI was at, or just a binary, did this crossover or not. To keep it simple in this example, I would just say binary. Did it cross? Yes, it crossed over within the last, say, 4 candles or 4 days. Take a look here at this next occurrence. Again, it crossed over within the last, actually, pretty much almost bang on with this occurrence. RSI crossed again. Here, it did not cross, but you can see that the price just chopped sideways until it did cross. So you can see how you can use the criteria where it's like, I need more than one of these items to be met. And now you're understanding how to use indicators as well. Because, when we first start out, we might want to use RSI as a reason to enter a trade, and it's not. No indicator by itself is a reason to enter the trade. But in this occurrence, we broke this downward trend line, and we're assuming that we're breaking out back towards a mean reversion. I call that breaking out. Uh, but if you didn't get the RSI signal, it would have stopped you from chopping sideways all this time. And then when you did get the RSI signal, you'd already gotten the breakout from the downtrend right here. So those two criteria are met. That might be enough for you to take an entry and you would have had a nice win. Let's take a look at this event. No, we didn't get it here. You would record that as a no. RSI did not cross over there. I'm not sure if you want to call this a crossover. I probably wouldn't, because the slow line is quite elevated, and really we just touched here. I wouldn't call that a crossover. You have to meaningfully cross down below the slow line and then see the fast line bounce back up meaningfully above, which it did here right before our next event. We've got another spot here where it crossed over right before our next event. And in this particular case, it did not, but this trade didn't work out. So the fact that you didn't meet both criteria would have saved you from one trade that didn't work out. And that's very meaningful because that one trade in this small data set would change the outcome significantly. It changes your win rate significantly. And our next spot here, we did. And you can see that this trade still would not have worked out. But that's okay because out of the, what is it, eight, looks like about 7 or 8 trades that we recorded, we have one trade that wouldn't have worked out at all. And we have a few trades here that would have worked out spectacularly. You can then go back and cross-reference, okay, was there something on RSI that told me to, to take my exit? If it gets really oversold into 80, is that a reason to take an exit? I'm not going to answer that here because what we're doing is we're just demonstrating how to continue doing this forward test, or I guess in this case, continue doing the back test. But you want to get this criteria into your forward test. That's why we're having this conversation right now, is to identify another piece of criteria that will get you into that you can get into the forward test. Then after that, I'm just going to get out of this screen share. Give me one sec. Okay, so after you've introduced a new piece of criteria, then what you do is you forward test it. You record all the new events that happen. Now, why do you forward test it and not just back test it? Because it's all well and fine to say that something worked out in the past. That's totally fine. But I promise you that when you're in the moment, and something is just kind of starting to break out, and RSI is just kind of crossing, the fast line is just kind of crossing over, that's the way it looks in that moment in real time. The feel is completely different than when you're backtesting it, looking at it in reverse and seeing, I mean, you can clearly see how it worked out right in front of you. So that's where the forward test comes in handy. Now, I want to qualify this. Again, this is a lot for day traders and swing traders. If you're trading on a longer time frame, you're trading less on technicals. Technicals might just be a good reason to enter. They might be showing you where to enter and where to exit. But technicals don't mean as much. The farther out you go, the more your tests are going to look like testing off of fundamentals, testing off of maybe earnings come in, and earnings are earnings. They often mean less than the guidance. So you're looking at some specific stocks, some specific names. You're looking for names that have momentum. They're in strong sectors. Again, this is for a position trading type setup. And you're watching on that earnings day. You want to see that strong guidance comes in. And if strong guidance comes in, that's more of your entry criteria in that particular situation than the chart would be, because technicals are for shorter time frames, and when we start going further and further out, fundamentals just matter a whole lot more than technicals do. So that's it in a nutshell, but if you don't completely understand this, if you're still a little lost, that's because we've moved so fast. We have moved unbelievably fast. Guys, it took me about 18 months to figure this out. When I finally sat down with some back testing and started building some spreadsheets for myself, to the time that I tested 10 or 11 strategies, whatever it was, and figured out what exactly I wanted to dial in on, It was about 18 months. So we can't expect you to get this in only 4 videos. That doesn't make sense. And that's where the mentorship program comes in. Can you figure it out from what we've talked about? Probably. Maybe you're okay with spending a year or 18 months just figuring it out based on what I've given. And if that's the case, it's my gift to you. Please take this, run with it. It's a free gift. I really hope that you get consistently profitable. But for those of you that want more guidance, that's why we're going to be starting up the mentorship program. And even now, I'm dropping my email in some of these videos. Feel free to email me with questions. I'm even willing to do a Zoom meeting, anything like that, just to get you guys started, get you guys pointed in the right direction. If you're excited about stuff like this, because hey, you know what? This is actually what makes you consistently profitable. Jumping around from strategy to strategy and looking at something exciting over here, something exciting over there. I have a feeling that that doesn't really appeal to this crowd. You guys want to know the real answer. And that's what we're doing. And that's why I want to make my email available to you and make myself available to answer any questions you have. There's one more step, and it's just continuing to refine, continuing to review and refine. I'll discuss that in the next video.